Ladies and gentlemen, let me welcome you to today's podcast. I'm Subodh Mishra, Director of Communications at Institutional Shareholder Services, and I'll be your host for this installment of the Pulse of Governance. We're talking today about the timing of stock grants as a potential means to increase pay for corporate executives. How prevalent is this practice? How do you distinguish between coincidence and strategic timing? And what's the ISS benchmark policy view on all of this? Lots of questions to get through, a very complex issue, and I am very pleased to be joined by two of my esteemed colleagues to help us sort this out. Brett Miller, Head of Data Solutions for ISS ESG, welcome to the program.
Thanks for having me, Subodh.
And Rachel Hedrick, Senior Compensation Analyst within ISS's U.S. Research Unit. Thank you for joining us.
Thanks, Subodh.
Great. Very pleased, like I said, to have both of you here. And let me just dig right in. I want to start with you, Brett. So you've done some research on this topic. And based on that research, what have you found with regard to some companies using grant award timing to increase payouts for executives?
Yeah, so the increase in payouts will generally stem from granting at the right time, near the stock price low. And maybe it's not near the low, but maybe it's before an expected increase. Maybe there's going to be positive earnings or an important announcement. And boards will typically target a dollar value of equity compensation. So you take the number of shares multiplied by the grant date closing price, and that's how we come up with a grant date fair value or disclosed award value. So when you are able to grant at a time where the stock price is lower, you're naturally going to be able to increase the number of shares that an executive gets, thereby increasing the realizable pay. And there are three primary ways that companies can time their grants. So the first would be granting shares before the quarter ends if earnings are strong, or granting after earnings are announced when they're not strong. The second would be to grant awards closely together. So let's say I've got one grant that occurs and the stock price it comes down a little bit. Then you have the ability to make whole the entire grant by granting a second grant. So that's another way. And then third is granting shares outside of the typical grant cycle or an out-of-plan award when the stock price is at a recent low point. And those are the three primary ways.
Got it. So that I understand. But how pervasive is this, and what, essentially are the benefits?
So earnings timing is not all that common. The secondary grants happen quite a bit and are rarely noticed because the company is essentially trying to get to that targeted grant value. There's nothing wrong with it other than the fact that an executive is going to get more shares as a result. And then the out-of-cycle grants are very rare. So if you take the 190,000 grants that we have in our database over the last 5 years in the Russell 3000, only 10,000 of those are considered to be out-of-cycle grants. And then of those 10,000, only 4,000 of those are considered to be well-timed. So it's very rare, but it is common to see it every single year. And what are the benefits? If I'm an executive and I receive 1 million shares at $10 or 2 million shares at $5 a share, my total compensation will be disclosed as $10 million either way. So if my stock price increases $1, in either scenario, the realizable value of my equity with 1 million shares is $11 million, but the realizable value of my equity with 2 million shares is now $12 million. So just because I timed my award well, I got an extra $1 million in realizable pay. So in times of layoff and volatility, executives can receive the same shares at a lower price and mask it as a pay cut, or take a reduced salary while being made whole on the equity side without increasing your actual pay. So quite a few benefits from an executive perspective.
Yeah, I can see that. Rachel, let me bring you in here. What is the ISS view on these grants, I guess, from a benchmark policy perspective?
Sure, Subodh. So as Brett noted, the awards that are made together, where an award is made, part of an award is made, and then the secondary part of an award is made, those grants are looked at under our normal pay performance considerations. But under our U.S. benchmark compensation policy, we do an evaluation of outside of plan or one-time awards. And that's really focused on three main components. First, whether the award is non-recurring in nature. And what I mean by that is the special award granted on a one-time basis, or is it something that looks like it's being done regularly? So are these special grants being made really as part of the pay program? We look at special awards as something that should be made sparingly and in connection with some kind of a compelling issue that may arise only occasionally. We don't view special awards as something that should be a tool to regularly supplement compensation opportunity. So when one-time awards are made, for example, in consecutive years, or look like they're creating a pattern, then that suggests to us that they are part of the regular practice, and that might signal a potential problem to us to look at more closely. The second area of focus would be the company's rationale for making such awards. We're looking closely at disclosure of what the board's thinking is. So we want to see these awards made under special circumstances, and we believe that the board's thinking should be clearly disclosed to shareholders. So boilerplate language like reference to retention concerns without any further explanation wouldn't be viewed under our benchmark policy as sufficient. And that disclosure should make clear to investors what the issue was that warranted the special award and how that award is intended to address it. So I point this out because there's a tendency for companies to neglect to address the rationale part, but the proxy should explain the board's thinking around the award. So how did the board determine what the award magnitude should be, vesting design, how are those decisions aimed at furthering the board's goals? And the disclosure points should complement each other. So for example, if the board cites retention concerns, then a short vesting period on the award wouldn't align very well with the board's explanation. Then the last area of focus are the typical pay for performance considerations. So the design, the performance-based nature, and then the timing of the award. So as with the regular incentive programs, there's a general expectation among investors that outside of plan awards would also maintain some kind of a performance basis. So awards that are entirely time vesting or that lack any sort of disclosed performance vesting criteria would generally be viewed more negatively by the ISS benchmark policy than those with clearly disclosed forward-looking goals. And then special awards should also have some kind of vesting design that limits acceleration upon termination events. So we view it as best practice for these type of awards to be prorated in the event of a termination without cause or forfeited for resignation or termination for cause. We look at these vesting provisions as part of the windfall potential for a particular grant. So for example, a newly promoted CEO might be provided with a significant promotion award or one-time award that's intended to cliff vest after a few years in the role. But within the first year, the board determines that the CEO is not really working out. Maybe performance is poor, share price drops, the board decides to let him go, which would typically be a termination without cause. Yet the vesting of that special promotion award might be accelerated in full, resulting in several millions of dollars of cost to investors potentially who might have seen losses on their investment under this person's new leadership. And so that's a classic pay for failure scenario for us that we think can be avoided by limiting the vesting potential upfront.
Got it, and certainly that's a lot of diligence, and that scenario you just detailed is helpful in my understanding. But let me stay with you, Rachel, and ask, where does award timing come into play, under these assessments?
Sure. So award timing can certainly come into play for us, particularly when the potential risks connected to the timing are not well explained in the proxy statement, or if the risks are not limited by vesting design. So, for example, as Brad was talking about option awards. So option awards that are granted shortly following a steep decline in stock price, investors are looking for disclosure about was it the board's intention to award the options at the low price in order to maximize the upside potential, or how did the board consider altering the number of options, for example, that were granted once they realized that the stock price was at a low compared to the prior trading days. In such cases, investors may expect the options to carry a significant premium on the exercise price, or potentially for the board to have mitigated the windfall risk by addressing the number of options that were ultimately awarded. And this concern is even more pressing for volatile stocks. Otherwise, you can end up in a situation where a large option grant is made at a low in the stock price, and then a sudden rebound in the price is going to create options that are very much in the money, very lucrative to the recipient, even if longer-term investors are seeing flat stock price or perhaps even negative long-term returns. And this creates a clear contrast between the long-term investors and the one-time award recipients who are benefiting from a fluctuation in short-term stock price. So in such cases, we're looking for companies to clearly disclose the board's thinking about the grant timing and also an evaluation of any potential windfall risk.
Right. That makes imminent sense. And if I can stay with you, Rachel, in terms of the benchmark policy here, can these essentially drive negative voting recommendations? And if that is the case, would it be say on pay votes or just equity plan votes?
Sure. So we're looking closely at one-time awards when we're making voting decisions, particularly in the event of a pay-for-performance misalignment, and particularly under the advisory say-on-pay proposal. So many investors have told us that problematic one-time or special grants are really concerning to them. And so even if regular cycle pay programs or incentive programs look pretty good, a problematic one-time grant could drive an adverse recommendation on the advisory say-on-pay proposal. To your second point about equity plans, it's less likely that one-time decisions are going to result in an adverse recommendation from benchmark research for equity plan proposals. However, there have been, pretty limited circumstances where a pay-for-performance disconnect is driven by a problematic use of equity or a problematic practice in the use of the company's equity. And if the plan is not sufficiently broad-based, in other words, if equity awards are highly concentrated to the top executives, then there's the potential that ISS may recommend against a concurrent equity plan proposal on the ballot in addition to the say-on-pay proposal. Generally speaking, though, our first point of potential opposition would be that advisory compensation proposal.
Gotcha. Okay. Well, let me give you a break, and I'm going to hop back over to Brett. Brett, back to you to discuss your research, and so I think I'd mentioned at the outset of the podcast, one of the things that we wanted to get a sense of is distinguishing between coincidence and sort of strategic timing. What did you find there?
So we used our executive compensation data and the grant history over the last 5 years to distinguish what is a regular grant versus what's an off-cycle grant based on the prior year's timing. So companies are typically going to grant within 2 weeks plus or minus of the same time every single year. So to see a grant occur outside of that window in the current year based on your prior year would be what we would call a off-cycle grant. And what we say by that is we're looking at the first grant, the largest grant. So if there are multiple grants in the year, we're only focused on the one grant that had the largest grant. Anything that occurred outside plus or minus 15 days from the prior year is considered off-cycle. And then to determine if it was a well-timed or a strategic grant, we looked at how close the company's stock price was at the time of the grant relative to either their fiscal year low or the 52-week low. And then we kept a 110% threshold, so it had to be within 110%. And if it was in the first 3 months of the year, we used 52-week low, and outside of that, we used a fiscal year low because boards can only grant as low as the current fiscal year. Essentially, was our thinking on that. And what we found is that companies that grant near their low on their regular cycle would see some volatility, but it would usually bounce back around 1% after 30 days. In comparison, companies that grant near their low outside of the regular grant cycle, so these out-of-plan awards, saw their stock price bounce back on average 5% over the next 30 days. And so we're not surprised to see this, but those returns didn't sustain over the long term. So over 3 years, we actually found it was the exact opposite, where the companies that were granting within the regular cycle performed 10 to 12% better than the companies that were granting out of their regular cycle over a 3-year period.
Gotcha. This is very interesting. And Rachel, I know that you're listening. And so, based on, what Brett just detailed, are there scenarios where you'll support these grants? And I guess another question for you, Rachel, just given your proximity to the institutional investors, how do they view all this?
Sure. So, we look at these grants on a case-by-case basis, like we look at, each scenario within benchmark research. So if the 3 main factors of evaluation that I discussed earlier are adequately addressed in the proxy statement, and the award is of a reasonable magnitude compared to the person in the company's normal levels of pay, then ISS might likely view the one-time award relatively favorably. However, obviously, to your second point, investors don't uniformly evaluate one-time awards. In fact, I've heard from some investors that they will almost always oppose such awards. Some do a case-by-case analysis. Some rely more heavily on the ISS research. But generally speaking, I would think that if the one-time award is in fact isolated, non-recurring. The rationale is robust, including a discussion of the magnitude, any timing issues, particularly with options, and the award design is performance-based with appropriate vesting safeguards, then I wouldn't predict that a company is likely to see significant investor opposition, to a true one-time decision.
Gotcha. And Brett, I'm kind of curious from, your vantage, what the feedback is that you're hearing with respect to your findings about these practices.
Well, so far, it's really a matter of who you talk to. If you look at some of the short-term active traders or quants, this is an interesting piece of information that they're now receiving from the company that is, to them, is a meaningful and important understanding of where the stock price might go in the future. Even if companies are not meaning to tell investors this, it was statistically significant enough that it is telling them something. So they found this as an interesting trading signal that they might use on a short-term basis. But if you talk to any long-term investor or stewardship teams or just anyone who's taking a long-term ownership position in the company, these are, as Rachel mentioned, they're generally considered problematic unless there's sufficient disclosures and there's performance condition, and if the board is very transparent about it, it's not the worst thing in the world. But in aggregate, I think the idea of manipulating the timing of an award in order to maximize to maximize the realizable pay for an executive is something that most investors who are holding these companies on a long-term basis would find problematic, and something that they've expressed need to monitor closely in the long run.
Right, got it. So it really depends on the view of the investor. And
one last thing, Subodh, I'm sorry. I completely forgot. Given that all the volatility that's occurring this year, I think it's going to be really interesting to see ultimately what companies do for the 2020 season, because of the primary time for granting is in March. So that's when there was so much volatility in the market that it will be interesting to see how the award justification plays out during that time. And then you've also got, given that 162M is no longer applicable, you might see some special grant timing this year that you haven't seen in previous years because it's no longer tax deductible.
Yeah, that's a great point. I didn't even think about that. But well, thank you for that, Brett. And Rachel, let me get back to you and give you the last word here. I mean, what would you tell companies who are trying to time their grants or are considering out-of-plan awards? What advice would you deliver?
Sure. Well, to Brett's point about how different types of investors think differently, my final word of advice would probably be that if you're able to speak to your investors before making the grant. A lot of companies have deferred early fiscal year grants, while they wait for or information about market conditions to be known. So if you have the time, it's a great idea to gauge your investors' comfort with the idea of an outside of plan award, get feedback on the general magnitude and the design considerations. And then this way you're able to get ahead of any potential concerns that your investor base might have. And then make sure that you thoroughly explain in the proxy statement the background of the issues, what led to the decision, and then any timing considerations that the board made. Don't rely on boilerplate explanations or assume that the reasons are obvious to investors, because investors and ISS alike were relying on the company's disclosure to be able to navigate the issue. And the more transparent and robust the explanation provided by the company, the better the likelihood that market participants are going to be able to understand the board's thinking and fully evaluate all of the components and issues that went into the grant decision. And we just think that that transparency and it will just result in better outcomes for everyone involved.
Yeah, that makes sense. Disclose. I guess that's always good advice under any circumstances. And so let me thank you both. Brett Miller, Head of Data Solutions for ISS ESG. I appreciate the insights.
Thanks for having me.
And Rachel Hedrick, Senior Compensation Analyst for ISS's U.S. Research Unit. Let me thank you for the perspective. Great to have you.
Thanks, Subodh.
And thank you to our listeners. As always, we appreciate you joining us, and do join us next time for the June edition of the Pulse of Governance podcast. In the meantime, take care and goodbye.